If the AI bubble pops tomorrow, your favorite altcoin probably drops 40% before lunch. That is the uncomfortable truth nobody on crypto Twitter wants to admit in 2026. Right now, the entire S&P 500 has roughly one-third of its weight concentrated in a handful of AI-exposed mega-cap tech names. Nvidia, Microsoft, Meta, Alphabet, Amazon, Apple, and a few semiconductor suppliers are essentially holding up the index. When concentration gets this extreme, it is not a question of if a correction comes, it is a question of what triggers it and how hard the spillover hits crypto. Here is the part most retail traders miss. Bitcoin's 30-day correlation with the Nasdaq-100 has spent most of the last 2 years floating between 0.4 and 0.7. That is not a hedge, that is a leveraged tech beta. When the Nasdaq sneezes, Bitcoin catches the flu and altcoins land in the ICU. Ethereum is in a slightly different bucket. Because of staking yield, restaking flows, and the ETF holder base, ETH has shown moments of decoupling from pure tech risk-off moves, but only after the initial liquidation cascade clears. In a sharp AI-led drawdown, expect ETH to dump with BTC for the first 1 to 3 sessions, then start carving out relative strength if real yield narratives hold. Altcoins are the worst place to be in this scenario. In every macro deleveraging since 2018, the alt to BTC ratio has bled 50 to 70% before any bottoming process even begins. AI-themed crypto tokens are especially exposed because their entire valuation thesis rides on the same narrative that just broke in equities. If Nvidia loses 20% on a guidance miss, AI tokens on-chain do not lose 20, they lose 40 to 60. So what is the playbook? First, watch the VIX and high-yield credit spreads, not crypto Twitter. Credit cracks before equities and equities crack before crypto. Second, track Bitcoin dominance. A spike above 62% during a tech sell-off is the classic flight to quality signal inside crypto itself. Third, do not assume stablecoin supply growth will save the market. In a real liquidity event, USDC and USDT supply tends to flatline or contract, not expand. The honest base case for 2026 is that crypto is no longer an uncorrelated asset. It is a high beta expression of global liquidity and tech risk appetite. If you want to position for an AI bubble unwind, size accordingly. Drop a comment telling me which single altcoin you think actually survives a real tech-led crash, and I will cover the top picks in tomorrow's video.